Hello, everybody. Welcome back to another episode of What the FinTech Internet Radio Show. Thank you for joining me. I decided to take a video of this episode. It's kind of a big deal to move from just audio over to video, but I won't let it distract from the content of this show. I'm going to get right into it. I'm not going to beat around the bush here. There's a reason why I decided to take a video of this episode rather than just straight up recording it as we usually do. This episode tonight, clearly, I'm by myself. This is your host, Cian Lynch of What the FinTech Podcast. This is episode 15 or even 16, I believe. The number does not matter. The message is what matters. And that's exactly why I'm glad that you're here to listen to me speak tonight. First off, this video is related to economics and personal finance and money management and etc. If that doesn't interest you, feel free to click out of this video or close this podcast, however you're listening. If it's not for you, it's not for you. That's fine. For those of you who are still interested in listening to this video, to this podcast, I'm just going to call it to this episode. I got a real treat in store for you tonight. I appreciate you joining me. And as I said, there is a reason why I decided to take a video tonight as opposed to just recording. The reason for that is, as of tonight, I'm offering a service to anybody in the world that's interested. Just recently, I achieved a big personal financial goal that I had set for myself. I'm real glad that I achieved it. I worked really hard to get there. And basically, I've become somewhat of I've become a personal fintech analyst. And what that means is I study financial markets, specifically technology-focused markets, in addition to the traditional markets as well. And I help myself and other people make money through safe and risky investments everywhere in between. And so I understand that with a lot of people my age, recent college graduates, a large issue is student debt. And I want to help people manage their student debt from now on. It's something that I believe I'm qualified to do. I'm not here to preach to you my different qualifications and my accomplishments that have brought me to this position. We can talk about that in person if you're really that interested. But anyway, I'm offering a service to anybody that's interested, helping them understand what's going on in financial technology, helping them understand how they can start paying off their debt, while they sleep or, while they work their day job, basically just creating supplemental streams of income to help them in terms of personal finance. It's something I'm passionate about. It's something I really care about. And I think I'm good at it. And so that's why I decided to make a video tonight. So I'd never like to be the guy that just talks about, X, Y, and Z. I like to really demonstrate that. So if you choose to stick around with me throughout this video, I'm going to break down a few of the different markets right now. We're going to talk macroeconomics. We're going to start at the very high level. We're going to work our way down. We're going to go through inflation, stocks, bonds, precious metals, cryptocurrencies, and everything in between. So I feel like this video is making me look real white, like real pale. I don't think I'm that pale in real life, but I don't know. So basically, I said that I wanted to start this video out and talk at a macroeconomic level. So basically, looking at the economic cycle that we're in, where are we right now in relative to history, and where are we going? It's real important to understand that, I say I want to help people with personal finance, and I want to help people, manage their money, pay off their debt. Like becoming debt free is a big thing for me. I place a lot of emotional value on it, and I think that, for some people, it really helps them with peace of mind. I'm one of those people, and if you are as well, I'd be glad to help you with a free consultation, just to help you out, just to have your back. And having your back is something that me and my team do. I work with Backham Company. We are a financial technology advisory. We work with companies and individuals as well to take full force of their financial lives. And yeah, we're a young group, and we're aiming to help young people as well, in addition to educating anybody that's interested. So, enough general talk. Let's talk some macroeconomics. So, getting started out, when we talk about macroeconomics, the most important thing to talk about is central banking and interest rates and the federal funds rate in the United States of America. So I'm going to start real basic here. Every 95% of all nations in the world today have a central bank. The central bank is in charge of monetary policy for that country. What monetary policy means, at the bare minimum explanation, is how much currency exists in the economy and how much does it cost to borrow the currency in the economy. So when you're trying to figure that out, you need to look no further than the base interest rate of the economy that the central bank sets. Central bank's in charge of setting this rate, and then this rate is applied throughout the entire economy. I'll get into that in just a moment. So I mentioned the Federal Reserve for the United States is in charge of setting the federal funds rate. The federal funds rate is the base rate of which all interest rates are set in the United States of America. So what I mean by that is you have the federal funds rate that's set currently it's around 1%. It's relatively very low compared to historical trends. But I'll get into that in just a moment as well. It's about 1%. And then from there, you have other rates such as student loan interest rates, credit card rates, mortgage rates, car loans, et cetera, et cetera. So it's at 1% right now. It hasn't always been that low. It's only been that low since about 2008 when the recession hit. Basically, what goes down is in times of a recession, businesses need capital to go about their operations, to start businesses, to run their businesses, to buy inventory. I'm not going to go into all the different costs of running a business. So that rate has been near zero for almost a decade. They're starting to raise it. So it's actually really fucking important to understand the turning point that we're currently in. We're currently experiencing a turning point in the economy when it comes to monetary policy. So as I said, 2007, the interest rate, let's say, was around 6 or 7%. I'm taking a shot in the dark there. Recession hit, they cut the rates down to zero, so that money becomes almost free. Anyone can borrow it. You can do whatever you want with it. You can invest it. You can start a business. It kind of invigorates the economy, this cheap money. It's been that way for about 10 years, and coincidentally, we've seen the stock market rise for about 10 years. Then, late 2016, they decided to raise rates for the first time. Big deal. Big fucking deal. They raised rates from about 0.25 to 0.5%, which, as I said, is not a lot, but it's a turning point. And ever since then, we got the rate is about 1%, and we're expecting several more rate hikes by the Federal Reserve over the next few years. What this means is money becomes more expensive. It means businesses become harder to run. It means that there's less investment because, like, let's say that you're a hedge fund, for example, or if you're, I don't know, a bank, whatever you want to do, some kind of entity, and you borrow $1 million. If you got to pay $1,000 on that, you still have a fuckload of money to invest. But let's say interest rate rise and you got to pay $10,000 on that, then you have just that much less. But that means everybody has that amount of less in order to invest. And it also means that, that money that you're not investing, that you're paying to interest instead, no one gets that money anyway. So regardless, I wanted to set the stage for where we're at. We're at a period where the Federal Reserve wanted the economy to be doing well. They're like, here's some cheap ass money. Take it, do whatever you want with it, grow the economy. And now they're at a point where they're saying we got to raise rates. And so you might be thinking, like, why would we ever raise rates if low rates are good for the economy? And it's a fair question. But when it comes to macroeconomics and the brilliant economists that we have in this country and around the world, they want to protect us from something called overheating of the economy. Basically, when stuff is going too well, inflation starts to pick up, and you get bubbles. Bubbles, yeah, it's true. You got bubbles in the world. So they're protecting us from the bubbles, supposedly, and we got to react. And that's the name of the game, and that's something that I love to do in terms of economics and investing. I love to react to market news. So that's the stage. And now I'm going to move into the next item, and that's stocks. So actually, I'm sorry, I want to go into inflation first. So I just mentioned inflation, and basically they raise rates to curb inflation, to reduce its effects. Let's just talk common sense here. You're not able to reduce the effects of inflation unless there's inflation to begin with. So just by raising rates, the Federal Reserve is admitting that there's inflation in the economy. Inflation means prices are rising, things become more expensive, the cost of living goes up in the economy. It's one thing to keep in mind. There's a couple of inflation killers that I like to call them. I call it the inflation badass crew. And before I even say what they are, I need you to understand that my economic train of thought, nobody else has this train of thought. Nobody else will talk about these kind of things. No one else thinks like this, or even if they do, nobody's stupid enough to say it out loud. But I'm just dumb enough to do it. So the inflation badass crew, it's gold, it's silver, and it's Bitcoin. I'll get into those three things later. And to be honest, this video is already 12 minutes long. I'm really using a lot of breath here, but this is important. I believe that the world needs this video, so I'm going to finish out with it. So as I was just saying, inflation's on the rise. It has been for quite some time. You don't really need to do that much research to understand that it's over 2% a year. All the Federal Reserve talks about is 2%, 2%, 2%. That has been their goal, like the goal of the Federal Reserve over the past couple of years. What they want to achieve is 2% inflation. They're like, oh, we never achieved 2% inflation. They finally achieved it. It's the most recent thing I read today was that the revised inflation rates for 2018, full year 2018, is 2.45%. It's a very healthy rate. It's up there. It's not as low as it's been from the period of 2008 to 2014, 2015, 2016, anything like that. So we have a very healthy inflation rate. And I mean, when I say healthy, I mean it's healthy for the economy. It's not necessarily that healthy for the individual to be experiencing inflation. Personally, I don't like inflation. I understand that it's good for the economy, increases earnings for businesses, etc. But it hurts savers. It hurts individuals saving money. Let's say that prices in the economy go up by 5% in 1 year. If you don't grow your money by 5% as well, then you become 5% poorer. And people can be like, it's not that simple, Cian. It's not that simple. It's like, no, dude, it is. So inflation is here. It's around us. It's existing. It's going up. Look around. Gas is going up. Basic goods are going up. I'm not going to get any further into it. Let's talk about stocks. I mentioned earlier in this video that when the Federal Reserve slashed interest rates to near 0% back in 2008, and they slashed them, and it's been near zero for about 10 years. Coincidentally, the stock market's been on the rise for about 10 years, except for the year of 2018. So we started this rate hike cycle, increasing the rates, also known as tightening of the economy. And ever since then, aside from the few months after the Trump election, the stock market has been shaky. No ifs, ands, or buts about it. You look at 2018 so far, I think we're down like I don't know. We're down. We're down for the year. I'm going to go ahead and say maybe about 10%. Just taking that charge for the S&P 500. It looks really weak. A lot of people blame it on the trade wars. I think that's. I think there's some merit, a little bit of merit to it, but not the whole story. The whole story is that valuations for stocks have been incredibly high for a couple of years now, and everybody knows it. You look at any valuation metrics or anything similar to that, and it will tell you that stocks are overvalued. And 2018, we've seen a bit of a tumble. In this month of May 2018, they've been doing well, but for the year, it's been really, really shitty. People have lost money on investments that are supposed to make them money. So it's a big deal, and that's what happens when it comes to tightening of the economy. When you're raising interest rates, money becomes more expensive. Businesses don't have as much money. They don't borrow as much money because it's expensive. They don't have as much money to run their businesses. Investors don't have as much money to invest. There's not as much money going around. It's hard to get loans in the first place. It's really difficult. But it's not all bad. I'm here to tell you that it's not all bad and that opportunity exists all around us, at least in my opinion. So I'm going to take a quick break. I'm going to play little tunes and get ready for the good news of the economic cycle. Okay, we're back. That's the break. That's the intermission. So I want to talk about 3 more economic items, economic asset classes, or just asset classes, you can call them. Firstly, I'm going to talk about bonds. Then I'll talk about precious metals, and then I'll talk about cryptocurrencies. So firstly, with bonds, the bond market is one of the most intriguing markets that exists today. It's also one of the most complicated markets that exists today. So I'm not going to get into all about monetary policy and how everything works, but let me just say that bonds are incredibly interrelated to monetary policy and central banks. Talked about interest rates and how they keep them low. Bonds are a vital part of that process. You can ask me in my free time about how the interconnectedness of interest rates and bonds. I'd be glad to tell you. But anyway, what I'm about to say plays into it anyway. So bonds, when you look at the health measure of a bond, you need to look no further than the yield. The yield is basically, how much money you get for the bond. You give your money away to somebody for a set amount of time, and then at the end date of the bond, they give you back your initial amount plus the yield. The biggest bond issuer in the world, the biggest bond seller in the world is the U.S. Treasury. So you can look at U.S. Treasury bills and bonds to kind of get a good sense of where the bond market's at. Analysis of the U.S. 10-year bond shows that bond yield shows that bonds are becoming more attractive. The yields are increasing, which means that it's better to buy bonds now than it has been in a while. The yield on a U.S. 10-year Treasury bill is at the highest level it's been since 2009, and you can take that any which way that you will. I'm not going to sit here and dig too much further into the bond market because, as I said, it's incredibly complex, and basically I don't want to go on for another hour and a half here. This is just a video and a podcast. So bonds, basically what I want to say, they're in a healthy place, but we do need to notice the rise in bond yields. There's a reason why yields are increasing. What's that reason? I'm not going to theorize on this video. You can talk to me individually if you want to understand that and what I think about that. And while I'm on this topic about talking to me offline, you can contact me in a multitude of ways. Firstly, I'm going to leave a contact link through Backham.co that will allow you to get in contact directly with me. And aside from that, any other method that you can find to speak with me, go ahead and do it. Go ahead and do it. I'm also really interested in hearing the thoughts of others about economics and investing. I love to be challenged. Do everything that you can to challenge me and my views. I will back up my shit with evidence, and then gladly listen to others. As much as I love to project what I know onto the world, I also love to learn. Learning is the best thing ever to me. It's even better than partying. That's what I think. All right, I'm going to plow through the rest of these topics. So, precious metals, they took a downturn this month, but don't get discouraged. Precious metals time has not come. Precious metals thrive in times of inflation and in times of economic recession. That has not come. Precious metals, I see them about as steady as a bull. Imagine a bull in I don't know where bulls sleep, in a little bull barn. Imagine a bull wakes up from its slumber. It gets up. It's ready for the day. That's about precious metals. They're ready to charge out of the bull barn and they're ready to go. That's my thoughts on precious metals. You can disagree. I don't care. So I want to move into Bitcoin and altcoins. So Bitcoin is the way that I describe Bitcoin is it's a digital version of gold, except it lacks a few qualities, such as being something physical you can hold in your hand, but then it does have the trade-off of you can send it anywhere around the world almost instantly with really low fees. So they're similar, but obviously Bitcoin has a lot more weaknesses, and its weaknesses are much more pronounced than gold. I'll make another video basically just describing Bitcoin by itself. But I do really believe in the technology and use case of Bitcoin alone. Its price right now is in the mid 8,000s. And I don't know. Basically, what I'm trying to say here is that these cryptocurrencies have become a very important piece of millennials' portfolios nowadays. We saw a meteoric rise in prices for cryptocurrencies in 2017, growth rates that have been unparalleled in my lifetime. And I took note for sure. It was one of the most fascinating markets I've really ever seen. And even in 2018, the market has been really up and down. The prices haven't recovered to their all-time highs, but that's okay. Free markets don't always need to exist at all-time highs, because in reality, the biggest opportunity is born in the downturns. So what I'm saying, yeah, now is the time of opportunity. But I mean, it's really confusing, and I really don't. I wouldn't say to get involved unless you really know what you're doing. And as always, never risk more than you're willing to lose. So cryptocurrencies, they're up and down. But the important thing is that they're important nowadays in 2018. They're not going away anytime soon. So those are the points I wanted to hit at. I wanted to demonstrate a little bit of the knowledge that I have in terms of economics, and I wanted to kind of expand upon my economic and investment thesis. I'm one of the safest and biggest contrarians that there really exists. I believe that I have a unique philosophy when it comes to investing. I've used it to help myself become debt-free, and I want to help other people achieve the same exact thing. It's something that I'm passionate about, something I believe is important, and it's something I believe that the world needs today. So me and my team will be glad to help anybody that's interested. and that's it. You just got to get in contact with us, and we'll go from there. Then the magic happens. So thanks for your time tonight. Really appreciate it. As always, reach out with any questions, and thanks very much. And have a good damn night.